by any means a new issue to this. Back at the turn of the last century, after World War I, the U.S. was massively in debt. Part of the problem that caused the Great Depression was the debt that's hangover from World War I to this. And at that particular point, they set up the global system of taxation that began taxing U.S. citizens around the globe with this. Malaysia gets a fun bit of this, to this. Thailand has a United States double taxation agreement between the countries. What this does is it very clearly is a legal agreement that spells out certain aspects of taxation, including retirement savings, who taxes them, and what taxes them, and the percentages you have. Malaysia is more complex because it has yet to negotiate a tax treaty with the United States. This means that there is no legal basis as far as special basis for Malaysia itself. Everything is based upon the U.S. tax code. That's a little bit more punitive. And one of the examples of this is if you've got to take money out of an IRA or a 401k to this in substantial amounts of money, you will be taxed in the U.S. fully upon that money first. If you were to reside in Thailand when taking those distributions out, under the U.S.-Thai tax treaty, there is no taxation in the United States upon taking retirement savings out. Unfortunately, you guys don't quite get that benefit. You guys don't get that benefit unless you were to move your resident to Thailand during the year you want to take the distribution out. It is possible to plan to do that. We'll go into these particular two main points of being an expat. Foreign earned income exclusion. Okay, this is what most people will do, especially if they're earning wages here. Do this. You're going to get, for 2023, thank you to inflation, you've got $120,000 a year of earned income that can be excluded. I'll come back to that a little bit later on with this. Okay. You have two particular requirements. The first, or test you can meet. The first is the taxpayer must be out of the country for 330 days. Okay. Now, this is the physical presence test. Now, one of the big questions of this is, what happens if I move in say, July 1st of one year, and I move out in July 2nd of the next year? In that particular case, you could prorate, as long as you've done a 12-month period of 330 days out. It doesn't need to be the calendar year, it could be a partial year. And in this particular case, it would be 50% of the exclusion you'd be allowed to use. So if you made $70,000 of income in the second half of the year in Malaysia, you would be able to exclude up to $60,000 of that income. So you're able to use it based upon which percentage of the year you're in, as long as you've met that 12-month period in any rolling calendar period. It does not have to be the full calendar year to this. And this is where a lot of people do not take advantage of this, is because they lose that. They put this in the computer and it doesn't work out, but you can plan a split year on this particular things. However, I mean, how many people here are long-term residents to this? Okay. You've got the bigger advantage of this if you're earning income in it. Many taxpayers do not properly use this one, and this is a bona fide residence test. Taxpayer must be a bona fide resident of another country. Bona fide resident is poorly defined, but is considered to be a facts and circumstances test because the IRS will study facts and circumstances of personal residence. Is that as clear as mud for everyone? Yeah. Okay. Welcome to the joy of the IRS. Okay. Facts and circumstances means you're painting a picture to the IRS. Okay. You've got a long-term visa here. Your family lives here. You have no residence in the United States. You've been here for more than one calendar year. You're going to paint a picture to these guys on that I am living in Malaysia as my residence to this. And the 90% of preparers will go in and use the 330-day test because they don't understand the physical presence test. But here's the big advantage of the physical presence test. Your mother gets sick, you got to go back to the U.S. for 45 or 50 days to this. You're on vacation. Damn, I have busted the 330-day test. I'm going to be taxable on that income year-round. Not the case using physical presence test. Yeah. because your residence is here, you can go back and exceed the 30-day test in the United States without any real issues to this. You don't want to go 6 months, that fully makes you tax residency in the US no matter what. But I generally tell people don't exceed 4 with it. And it's a very specific reason if you're doing that. I've got to go in, my mother was ill, we take an extended vacation, we put kids in university, all these kinds of issues kick into this. But the physical presence test, or the bona fide residence test, if you're really residing in this country for a long period of time, just this test is the way to go. Because again, it gets you out of all the issues. You don't have to count your days in the US. With this, you don't have to count your days when you were in and out of Malaysia to this. And, it's pretty rock solid, but you just have to be able to justify with an auditor in the future and say, hey, I lived in Malaysia for 4 years. This is my home. To this. I'm not on a temporary contract. This is where I'm going to reside to this. Okay. Now the secondary issue to this is foreign tax credits. Okay. And we're going to use an example here of somebody who makes $200,000. Okay. And a lot of people will get this one mistaken. So let's say you make $200,000 and the U.S. Exclusion for that particular year was $100,000. And you qualify for the exclusion on your income. Now, when you run your tax scenario, you've got another $100,000 that's taxable in the United States if you just use the exclusion. Okay, so that's going to cost you about $25,000 to $30,000 of tax. Okay, now on that $200,000, let's say you've paid $50,000 of tax here in Malaysia. Okay, 25% tax rate. So what you would do in that particular case is, because this is a 50-50 split, you would take $25,000 as $50,000 tax you paid in Malaysia, and you would lose that because you've used that $100,000 as part of exclusion. But that still uses the $25,000 above the other half of $50,000 as being able to be applied towards the second half of the $200,000. Okay, so you can take the taxes paid in Malaysia against your U.S. tax liability on earnings earned in Malaysia. And this can be actually anything: interest, taxes, dividends, any type of income that's foreign source can be used that. So you're able to lower your U.S. tax bill to maybe $5,000 or $7,000 in this particular case by using the taxes you pay in Malaysia against your U.S. tax liability. Now, the reason I mention that math very carefully is that first $100,000 that's been, if you use the exclusion to this, the taxes paid on that you cannot use. You can only use it on the amount above that. Now you can choose, if it works out properly, to not use the exclusion at all. You can just use foreign tax credits. And there's a lot of times that actually makes more sense than it does with using the exclusion with this stuff.
Yeah, here's a question for